Welcome to This Explainer. Okay, let's jump right in, because today we're completely tearing down those get-rich-quick illusions you always see floating around online. Instead, we're going to look at the raw, statistical reality of what it actually takes to be a consistently profitable day trader in 2026. No hype here. This is all about building a systematic, highly structured business from the absolute ground up.
Right off the bat, we need a massive mindset shift. Listen to this. Trading is not about being right, it's about being profitable. I know, it sounds crazy. Most people think trading is about predicting the future, like you need some kind of magical crystal ball. You don't. It's really about leveraging positive expectancy and understanding mass human psychology. You don't get paid for being right, you get paid for managing risk and letting the probabilities just play out. Here's our roadmap to get you there. We're going to start with the counterintuitive math of profitable trading. Then we'll hit the 3 pillars: trading psychology, risk management, and price action. Finally, we'll bring it all together by building your trading system.
Let's start with Section 1, the math of profitable trading.
I want to immediately break what is probably the single biggest myth in the entire industry. Seriously, ask yourself, can you fail 70% of the time and still make money? Most beginners completely obsess over their win rate. They assume they need to win almost every single trade to be profitable. But let's look at what the actual math tells us, because the answer is honestly going to shock you. Think about it in terms of risk multiples, or what traders call R. Imagine you take 10 trades and you lose 7 of them. Ouch, right? Well, if you strictly control your risk to exactly -1 unit or -1 R on those 7 losses, you're down 7 R. But if you let your 3 winning trades run to an average of 3.6 units of reward, let's say taking home 5.2, 2.5, and 3.1 R, you actually end up with a positive net total of plus 3.8 R. Let's attach some real dollars to that concept to make it concrete. If you risked exactly $100 per trade, meaning your 1 R is $100, that 70% failure rate still nets you almost $400 in pure profit over those 10 trades. It completely proves that trading is absolutely not a game of being perfect. It's a game of data, rigid risk control, and letting probabilities work their magic over a large sample size. Moving on to Section 2, Pillar 1, trading psychology. Now that we've got the math down, we've got to master our own minds. This is the exact spot where 90% of retail traders crash and burn, no matter how amazing their strategy is. Almost every new trader falls into this trap we call the spin cycle. It kicks off with beginner's luck. You trade with zero fear because honestly, you just don't grasp the risk yet. And hey, you make some money. But that total lack of risk management leads directly to step 2, the big loss. You hold on to a losing trade, praying it turns around, and then bam, you face the agonizing emotional pain of blowing up your whole account. That trauma forces you right into step 3, paralysis by analysis. You're suddenly staring at charts all day, slapping on dozens of indicators, desperately hunting for a perfect setup just so you never have to feel that pain again. So how do we break out of that spin cycle? Well, you have to undergo a complete psychological rewire. You really need to internalize this idea. Losing is simply opportunity cost. You have to accept that calculated 1-unit losses aren't failures. Not at all. They're just the everyday operating expenses of running your trading business. When you finally detach your ego from the outcome of any single trade, you unlock the ability to actually execute. Psychology is your foundational anchor. Without emotional control and discipline, you're basically driving at night without headlights. Getting your mind right is the mandatory prerequisite that allows you to properly execute the next 2 pillars, risk management and price action. All right, Section 3, Pillar 2, risk management. This pillar is purely about your mechanical survival in the live markets, and the most crucial survival mechanism you will ever learn is the sacred 1% rule. This rule dictates that you absolutely never, ever risk more than 1% of your total account capital on a single trade. And to enforce it, you have to use mandatory, hard stop losses based on market structure, not on your gut feelings. If you're trading a $1,000 account, your absolute maximum risk on any single idea is just $10. By isolating your dollar risk to just that tiny 1% slice, you keep 99% of your capital completely preserved and safe. This mathematical boundary is a total game changer. It means you can weather those long, inevitable losing streaks, remember those 7 losses we talked about, without destroying your account. You literally live to trade another day, keeping your powder dry for when the high probability setups finally show up.
Next up, Section 4, Pillar 3, Price Action. With your mind right and your risk locked down, we can finally open up the charts to find our statistical edge. Now, a lot of people get bogged down memorizing dozens of complex, traditional chart patterns, flags, wedges, head and shoulders. It is exhausting. Modern-day traders don't do that. They strip all that noise away. Instead, they focus entirely on core market structure, the pure language of price. We're simply looking for uptrends, downtrends, and the underlying shifts in momentum between buyers and sellers.
To read that market structure effectively, your first step is identifying a break of structure, or a BOS. This happens when the price definitively breaks a previous high in an uptrend or a previous low in a downtrend. A break of structure is a massive clue. It confirms that the mass psychology of the market wants to keep moving in its current direction. It literally tells you who's in control.
Okay, so once we know the direction, we need to find an entry point, right? That's when you look for an FVG, or a fair value gap. This is a very specific three-candle sequence where an aggressive price move creates an extreme imbalance between buyers and sellers. It leaves a physical gap on the chart. And here's the cool part. These gaps act like powerful magnets. Price usually returns to fill them, which gives you a super high probability zone to enter the market right alongside institutional momentum.
Let's pull it all together into a complete strategy. We call this the power of three. First, you spot a change of character, or choke, which signals a potential trend reversal. Then, as the price starts moving, you look for multiple breaks of structure to confirm the new trend is real. Finally, you set a highly precise entry pulled directly from a fair value gap zone, keeping a very tight stop loss underneath. This exact setup is how you catch those massive 1-4 or 1-5 risk-to-reward trades.
Now for the final piece. Section 5, building your trading system.
Theory is great, but execution is what actually pays the bills. You have got to make that final leap from the amateur mindset, where you're focused on guessing right and letting fear dictate your moves, over to the professional stance. Your one and only job as a trader is to rigidly execute a positive expectancy model over a large sample size of data. You basically need to become a robot executing a proven business plan. So if you want to build your own system, you should follow this exact sequence. First, observe the charts and write down rigid entry rules. For example, requiring both a break of structure and a fair value gap. Second, paper trade those rules using simulated capital. Seriously, do not use real money yet. Third, rigorously journal 30 to 50 of those theoretical trades to mathematically prove you actually have an edge. And finally, once your data is consistently green, you can take an evaluation to use a prop firm's capital. This lets you scale up big time without risking your own life savings. Trading is incredibly simple at its core, but as you've seen today, it is definitely not easy. It demands intense, unwavering discipline. So I want to leave you with this final thought. Are you ready to stop gambling on random chart patterns and start letting the math work for you like the house in a casino? Think about how you can start applying these pillars right now. Thanks so much for joining me on this explainer, and keep mastering the structure.